All right, guys. Hopefully you can hear me okay. Um, just wanted to say thanks for everyone for coming. There's a few people here, and there's a couple of people that we're going to start in a little midway in, so there may be some people joining us. As you guys know, some of you were here last week for the home buyers workshop we did last Wednesday night, which was a great success. I think people took some good info from it. But one of the themes that kept recurring was mortgage questions. I think that's the thing that people are probably most uncertain about, what to expect, how to start the process, what things to look out for, all those questions that you probably have. Some of those, hopefully all of those questions we'll answer tonight. We're lucky to have someone with us. Before I introduce him, I just want to reintroduce our team at Landmark Property Group Compass. So tonight on the call, we have Allison Hargrave. She is going to be taking part in the question and answers as well. Also, Chris Cowie is another agent on the team, and he'll be participating as well. And then behind the scenes, we have our marketing and transaction coordinator, Emma Doring. And she's the brains behind the operation, and she's running the slides. So thank you, Emma, for taking care of all this and helping to set everything up. Quick message on the format tonight. Similar to last week, we're going to have Peter Fakaizen from Luxury Mortgage. He's going to go through some slides, not a huge amount, so it should be relatively high level. And then we're going to open it up to any questions that may exist. So for each section that he has, if you have questions at any point, please type it into the chat box. And then at the end, we're all going to unmute ourselves or, raise hands, ask questions. We would like to have a discussion as opposed to just, really like a kind of barking at you. We're going to give some information, he is, and then we're all going to answer those questions for you guys. If you could keep your audio muted just for the duration, and then type those questions in, and Emma will read those off. We'll get everything answered. And then the one thing we did talk about last week is the timeline of a transaction. So Emma's going to pull that up here. The reason why we're here talking with the mortgage professionals is because through phase 1, through phase 2, and phase 3 and getting to the closing table, one thing that is constant through all those phases is the mortgage part of it. So unless you are sitting on a boatload of cash and are going to plan to make a cash purchase, most of us on earth are using a bank to help us. And there's a lot of nuances to it. Pete will try to break that down for you, and so that it's not as overwhelming, because it really shouldn't be an overwhelming process. It should really be straightforward. And the reason you're here and the reason why you're ahead of the game against your competition is because you're organized and you're getting educated. So hopefully we can do that tonight. Without further ado, I will welcome Peter Fakaizen, and he has a quick bio that we've put up there. Pete, I'm going to put myself on mute and let you talk, and thank you for joining us.
Hey, what's happening, everybody? So a little bit about myself. I've been in the mortgage business for, close to 17 years. So, I know I can probably answer most of your questions pretty easily. I know that, buying a home, for the first time can definitely be daunting. And what we try to do with technology is kind of take that, scariness out of it and, make it a really easy transaction for you by being prepared up front and by informing you of, common pitfalls and, things to look out for during the process. One of the biggest things during the process is definitely working with a team. I think over those 17 years, seeing and hearing stories of people working with, all different sectors of the business, having an agent that doesn't know your loan officer, that doesn't know like an attorney to work with your process, can definitely be stressful. So we look to eliminate that, and working with Mark Hand, Allison, Emma, and Chris during this is it definitely makes things easier. So can we go to the next slide? So one of the most important things about buying a home today is really being prepared, and part of that is being pre-approved. when you're seeking a home, it's really easy to go out there and get pre-approval letter. But the most important part is really to come up with your strategy. I'm sure you hear the advertisements for Rocket Mortgage and other lenders out there that can do things quickly online, very fast. I think a lot of lenders can do that, but it's really knowing who's on the other line that you're dealing with, and that to make sure you're not dealing with a call center lender or even someone at the local bank, because a lot of these people don't carry the same licenses as the professionals that the Landmark Property Group works with. So, when you're getting pre-approved, we really try to establish, you know, 3 or 4 different things. And, number one, how long do you want to be in a property? Number two, what do you feel like your monthly spend is? Because a lot of the times we can pre-approve people for a lot more money than they actually want to spend. And I think that's one of the, biggest issues with a lot of these online banks and local banks is that they're just going to hand you a letter and say, here you go out and find a house. And, we try to really kind of take you through that process a little slower, and identify, again, how much do you want to pay per month, whether you're single, or you and your spouse or boyfriend or girlfriend are going out there and looking to buy a home. I remember the first time when I bought my house, I was like, I don't want to spend over $2,000 all in per month, knowing my normal expenses that I like to live my life, right? I think also, determining your down payment and where that's going to come from. And, that can fluctuate depending on the property that you find. So we like to keep some flexibility there too. You might find a home, you might be out there looking for a home at, let's say, $400,000, and then everything at $400,000 isn't what you like, but you found something at 350 where you might have to put a little, work into it, little sweat equity over the next like 3 to 4 years. So you might change your down payment from, let's say, 20% down to 5% down because you want to dump all that money into a property. So again, these are all the different considerations that we look at. And a pre-approval basically, goes through all these different, phases. First, we're going to get your information. Then we're going to basically say, where do you want to be? What's your max? We can figure this out very, very quickly for you. I think the real important thing is, we like to communicate. We like a lot of communication on it. That's so as you're out and you're set up with Landmark Property Group to go out and, look on MLS and start, seeing places and looking at numbers and, wow, I really like this. I think this will work. It's important that you have a loan officer and/or lender that can actually run those numbers proactively for you, right? So, we've got plenty of people out there right now that keep sending us stuff, and we turn around numbers really quickly once you're set up in the system. So a pre-approval is a lot different than another word you're going to hear, which is called a pre-qual or pre-qualification. Most of the online banks that offer these really fast, approvals and these letters so you can go out and look, they're pre-quals. They run your credit and basically say you're good, and they don't really look at anything else. So it's really important that you have a pre-approval, and more importantly, that we have a pre-approval strategy. Because again, having your agent work with your lender is really important, because putting in an offer today isn't just like snap your fingers and you're ready to go. There is a strategy on dates, like Mark showed in that timeline. That's really important, and it's trying to be as attractive to that seller as possible. And that's where we really try to help out. Can we get the next slide?
Pete, I just wanted to bring up, there was a question in the chat. Emma asked, once we have one home, what is a strategy or way to use your equity to get a second home and mortgage? And this is a question from more of an investment standpoint rather than a one-time residential home buyer.
Okay, so basically, how do you tap the equity in your current property to buy another property? Right? I can't see the question, so.
Yes, I can send it to you, or if you open the chat, but would you like me to read it one more time?
Yep, did you hear what I said?
I did not, sorry.
Okay, So basically, how do you access equity in your current property to buy another one?
I would assume that is the question that they're asking.
All right, so that's a great question. So, there's multiple different ways that you can, access equity in your current property. It really is going to depend on what you're going to end up doing with your current property long term. So, whether you're going to turn your current property into an investment and buy a new primary, we'd lay out kind of a strategy for that, either with a refinance to take more cash out or an equity line. But there's a lot of nuances with that question, because depending on how your income stream goes and where you're looking to gain other income, whether it's on a new investment property or whether you're turning your property into an investment, we want to make sure that you have a path, if you choose the equity line, to pay that off. Okay. When I talk about that, it means that I wouldn't recommend that, a W-2 person that works at, let's say, Fidelity or State Street, right? Or you have a fixed income of, let's say, $80,000 a year, you have no path to pay more than interest only, which is most of the home equity lines out there, to use as your down payment for another property, because you'd basically just be paying the interest only the whole time without paying off a lot of principal and interest on that loan. So again, it's either a refinance to access equity, or you'd have to get a second loan, either a fixed rate or a home equity line of credit on your property to do that. If that works. If it doesn't, you could put another question in the chat. That'd be great.
Awesome. Thank you, Pete. I'm going to go to the next slide now.
So applying for your home loan and applying for a mortgage / pre-approval, it couldn't be easier nowadays. So, on the slide, we list kind of all the things that you would need. This doesn't happen for every single loan, okay? It's actually a lot more streamlined than what we're showing. But if you were to take out, let's say, a loan over $690,000, that's all the information you pretty much need. If you're looking at a home under $690,000, which is what we call a conforming mortgage or a conforming jumbo mortgage in the state of Massachusetts, basically, depending on how you're employed, will depend on a lot of the documents that we need. So if you're a W-2 employee, right, with no self-employment, and you are banking with a major bank, and when I mean a major bank, not like a small little credit union, basically we can verify your income and assets online in your application process. And it's as easy as basically taking pictures of your documents and uploading them securely via your cell phone. That's how easy it is today to, get a home loan, get a mortgage approved, under $690,000. So, a few things when it comes to, when you're thinking about your down payment and assets, and it will be on the next slide in the do's and don'ts too, is, assets are one thing that, are scrutinized. And that's really because a lot of people that are buying their first home sometimes get gifts. Gifts can be given by, any family member, mother, brother, sister, father, aunt, uncle, grandparent, okay? Your cousin, on some cases, will take that. We'd have to prove that they're your cousin, which can be kind of painful. But they can give you any amount of money that they want to give you, okay? Just realize that the person giving you the money is subject to tax due to gift laws. And that person would have to talk to their accountant before they give you the gift to make sure they know what the consequences could be for them. Now, we also get a lot of what we call short-term gifts, and we still have to call them gifts even though you might pay them back down the road, okay? So a gift is defined as someone giving you money without an expectation in writing that you're gonna pay them back. If you're like, hey, I'm gonna give you, $3,000 a year for the next 10 years, to your grandfather, that's fine. That doesn't matter as long as it's not written in stone and it's something where, there's not an expected repayment, in writing. Okay. We can move to the next slide unless anyone's got questions on documentation. Mark asks, can you give the breakdown basics of principal, interest, taxes, and insurance? So basically what's included in your mortgage, whether, say it's a single family home, principal and interest is the amount of money that's given to us as your mortgage lender, okay? Your taxes and your insurance, basically are your taxes, your real estate taxes that your town or city charges you. Those are usually included with your monthly mortgage payment that we look at. And also your insurance, which could be called a hazard insurance binder, which is basically, hey, if your house burns down or you have a flood or a tree falls on it, that you're covered, right? So it's an insurance policy to protect the asset in case your home gets destroyed. So when we talk about principal, interest, taxes, and insurance, otherwise known as PITI, basically that kind of sums up your all-in payment that we look at for the home. The only difference that could happen is if your home is part of a homeowners association, which is common for some neighborhoods, or if you're buying a condo or townhome, where you have a homeowners association fee and or condo fee. That would be added into our, debt to income calculation as well. So Aaron asks, can you explain escrow accounts? Are these required if you're doing a payment of less than 20%? So escrowing for taxes and insurance are required for every loan under 80% loan to value or less than 20% down. I can tell you right now that, let's say about 90% of all homeowners in the country escrow for taxes and insurance. The reason being, it's simple and convenient. For condos, some people don't escrow when they've got equity of more than 20%. The insurance, because they like to pay it on their own, and sometimes it's not required for every condo. And that's not a lender by lender rule. That's basically a federal law for Fannie Mae and Freddie Mac, which are kind of the two governing bodies that most banks, look at their underwriting guidelines to, approve mortgages out there. So moving over to the do's and don'ts during this process. So, big thing, don't deposit cash. When you're doing the purchase of a home, do not go out, buy a new car, have somebody go out and buy literally a Mercedes the day of closing and blow their debt to income ratio out of the water. Try not to buy furniture without checking in with your, loan officer or lender. Don't co-sign on any loans. I've had people co-sign on their kids' college loans or their friends' college loans or their spouse's college loans when they're not on the loan. Try not to change bank accounts. Large deposits. So large deposits are if you were to make a deposit of over 50% of your gross monthly income. So if you make $5,000 a month, you deposit over $2,500, and it doesn't say from your employer, it just says like ATM next to it that you popped it in the bank. You'd have to show where that money came from. And that's the other thing is, part of what we do is we, thwart, money laundering. It's part of our job. So, you can't have cash. We look at 60 days back in bank statements. So, we've had people have gambling winnings. We've had people, collect money for their bachelorette or bachelor parties. I collected all this money for, just don't deposit cash. Just keep it for your expenses and pay it out. And if you do have to deposit cash, just make sure it's done way in advance of you buying a home. Your credit is monitored during this whole process with any bank that you work with. So trying to slip stuff by or, not letting people know, we know if you're pricing stuff out with another bank. We know once your credit's pulled once, you're in kind of a monitoring during your whole process until you buy your home. Because it's important that we know all of your current debts going into the process. And again, this is one of those things that thwarts people from taking out multiple loans on one property. We covered the furniture part. You know, don't blow the money that you save for your down payment. Credit card use, normal credit card use is fine. You know, I think we used to cover the fact that people used to travel. I think that's kind of tempered down these days with COVID, but you know, if you've got, you know, business expenses that have to be deposited in, go ahead. The key is just making sure you know, make copies of stuff that aren't being automatically deposited into your account. So if you get paper checks, etc. Big thing during COVID, luckily we've only had one, and I've only had one before in the last 17 years, where someone's actually lost their job during the process. So if you think you're going to lose your job, if you're in the service industry, if you're self-employed, it's really important that you have a strong pre-approval and someone's asking you these correct questions up front, because you can go all the way through the process. We have hundreds of people come to us, I'd say quarterly, where they've gone through 90 days of trying to refinance their home to come to find out because they're self-employed, it doesn't work. Well, that's because their lender's not asking them the correct questions up front. Like, what's your year-to-date profit and loss? We can't just, because of COVID, we can't qualify people, you know, we can't qualify people based off of last year's tax return. We have to prove that COVID hasn't had a negative effect on your business. So like waiters, waitresses, hairstylists have had trouble, you know, people owning restaurants, you know, any car service companies, Uber drivers. I mean, these are all jobs that people have, and there's a lot of people with those that can't really buy right now. So we got to make sure that we go through that process up front. We got a couple other questions here in the queue. Do people that are independent contractors have a harder time getting a mortgage than a W-2 employee? So there are more restrictions due to COVID, like I just covered. So can we qualify someone, and is it harder for us as the loan officer? No. Luxury Mortgage bought this awesome software within the last year and a half called LoanBeam, and we can read tax returns within 5 minutes, where some loan officers have to sit there and go through and do a manual process of doing this. So we have an automated tax return reader that spits it out, what your numbers are that match for the mortgage qualification process. And then we also ask the correct questions up front, like I just covered, where, you know, how is your profit and loss compared to last year? If I were to ask you for the 2 months bank statements to prove that you're still making this money, could you show that? So being a W-2 employee, definitely a lot easier because we don't ask those questions. You don't have to do as much work on your side. But again, we prepare you for this up front. It's not just, hey, you made 100 grand last year. Are you good this year? Cool. Here you go. Let me just type you up a letter. We're not going to do that for you. Okay. I don't want to waste your time, the real estate agent's time, or my time on stuff like that, where other people, again, you got to make sure you're not working with robots that are just, you know, just printing out letters, because again, your letter, your pre-approval letter, which is very important, is really only needed when you're ready to execute an offer strategy with your realtor and your loan officer. So, and those are, you know, we can get those to you 7 days a week in less than 5 minutes. But it's really about the strategy right now due to the, you know, demand of home buyers out there. So another question, what about receiving money from a wedding during the process? So great question. So we would ask you to make sure, you know, if you're getting married and you're going through that process, that once you do get married, believe it or not, we'd ask you for your, we'd ask you to deposit all the money at once. You know, this happens a lot in the fall and the spring and the summer when a lot of people get married. But we'd actually ask you to kind of prove it with an invitation. Say, hey, I just got married and we just deposited this, you know, big lump sum of, you know, 30 checks. Obviously, it makes sense. They're all from different people. But, you know, we would have to see a copy of those checks, which your bank can usually supply. So should be pretty simple. A lot of people mark a wedding. And again, we'd coach you up front to say, hey, listen, you got to deposit them all at once. Is there any other questions that we can answer for you? Pop it right in the chat.
And Pete, it's Mark here. Just, I don't know how many more slides you have, but if people, do you have more slides after this one? Because if not, we could have people unmute themselves. We may get a discussion going easier if they're able to just chat, talk or whatever.
I think that's it. Just the question slide. So
there must be some other questions. I know a question that I had that I bet some people, I think last week might have asked, was what type of tactics or what type of strategy do you use to distinguish, when you're working with a borrower, a buyer, and we're working with them, like I know the answer, but how do you stand out when they're making an offer and they're up against 5 other people?
So again, the strategy would be more or less like this, Mark. We would say, again, we're setting the stage from the beginning to tell you as that home buyer that you see something on MLS, you book it with your agent to go see it, or you make a plan to go see it with your agent. You go see the property, you speak to your agent about it, and then you and your agent kind of set that price of where you need to be. Because it's really important that you just don't come to us and say, hey, Pete, we saw this place, we really like it. And, can you run the numbers? We're going to tell you up front that in order for us to run numbers for you, we need to know what you and the agent think the offer price might be or close to. And by the way, we're not like afraid to run, 500, 520, 530 with your percentage down and spit you out some PDFs. Hopefully by that time you have a comfort level of where you want to be on your max price. But, the strategy is really, okay, you've come up with your price, you've come up with your plan. There's either 2 ways that we work to pre-approval. A, we want a pre-approval dated for the date that you're making the offer. Having a pre-approval dated 4 months ago doesn't do you any good because it doesn't show the seller that you actually went and sought out numbers for this property, right? And then really having a tactic with the pre-approval of, okay, are we going to make that pre-approval your best and final? Meaning you might be making an offer at 530, but you'll go up to 560. But we want to show strength, so we're not going to show them the 530, we'll show them the 560. Or you're saying, hey, listen, I don't want to go above this number. Let's make an offer right off the bat that's super aggressive, super serious at X price, right? So then once that's all taken care of, usually what I'll do is I'll send the pre-approval to you as the home buyer and then to the agent. And then what I always ask the agent to do is to call me or text me the seller's agent's information. And this is the real kicker, is that we give your pre-approval a personality. So what I do is once Mark, Ali, Emma, or Chris put that offer in, they text me and say, go ahead and make the call. We want to make sure that that other agent got that offer, that I'm not cold calling them. And then I give them a call and say, hey, this is Pete Fikaizen with Luxury Mortgage. I'm working with Mark Hand and his buyers, the Smiths. Just wanted to let you know how great the Smiths are. We've got all their documents up front. We've pre-approved them. I've talked to Mark about the condo and or the building, and I've reviewed all dates with them, and we can meet these easily, and I want your seller to know that. And then usually the agent's like, wow, this is great. You've just saved me a call, and it's a really positive deal. And then I always leave it off with like, I'm really looking forward to hopefully working with you. We're a local lender. I've been in the business for a long time. I'm not a mortgage broker. And, I'm going to make this really simple for, you and your seller. And we're at a very high percentage rate of making those deals happen. Because, Mark, I don't know what your percentage is when you do listings, but you probably don't get many people making that call for their buyers up front at all.
I really don't. I don't, but I'm surprised that I don't, because with all my buyers, I make sure, that call is made, because it does make a difference. And when someone's looking at 5 offers and they're all pretty competitive,
Right.
That is one way to say, well, I got a call from their lender and they're super organized. I mean, I always say to everyone, as organized as you can be, you know, these agents are busy. If you can reassure them that you, your attorney, and your lender are organized, and this isn't going to be a gong show, and it's not going to blow up. That's worth like an amazing amount for a listing agent. Huge.
Yeah. Yeah. I mean, any amount of time you could save them, and you know, it's a good call. You know, I think the other thing too that's important is that, you know, you guys as agents are, you know, you're really positioning whether that call should happen or not. You're the judge of it. So, you know, I think that's really important to put out there, because I know for a fact, folks, a lot of agents aren't recommending this. And I know when we put in offers and I don't make phone calls and they tell me it's going to be competitive, that basically it's we'll be back at running numbers again next week.
Mm-hmm.
And I'll tell you what, the other thing, Mark, that's been winning really well is just extreme buyer flexibility. Being flexible for the seller, you know, if it's a seller's market at the time that you're buying, being flexible to allow those clients to go out and find other, you know, other properties, or being flexible on the move date, or you know, whatever you can do to make sure that seller basically feels the best about you, rather than being super opinionated about, we got to do this, 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 and this by this date. That's worked out really well for a lot of buyers too.
It looks like there was a question there about why depositing all of the wedding money at once. Does that matter?
Well, just because we're going to have to show it all, you know, there's no tax, you don't get taxed on it. It's not income. So, you know, it's
Instead
going
of
to be,
doing it 7 times, do it once, right?
it's going to be easier for you to make that deposit rather than having to explain this multiple times.
Aaron, one thing when I got married is one thing that was really funny is we got checks from people, but a lot of the checks said both of our names, which was, you know, you can't call the person back, but it's hard if you don't have an account at your bank with both of you listed on there.
Right.
We had to like, it was kind of a whole thing. So it's one of those, it's almost easier if they write it to one of you, because you know you got a bank account, you just pop it in or whatever. But that part's a little, that's a little tricky part. Do you get what I
That's
mean?
funny. Yeah, we set up a bank account with both of our names, so maybe that will take care of it.
I was not as organized.
What's up, Pete? Hi.
What's happening, Aaron? What's going
Thanks
on?
for all the info. This is so great.
No.
I do have another question, if that's okay. Just about fixed versus adjustable rates, and sort of like the difference in what you'd recommend about that. And then also, you know, if you can't avoid PMI with a 20% or higher down payment, the difference between conventional and FHA loan. And I know it has to do with your credit score, but just sort of like pros and cons about those.
Yeah, so your first question, I haven't written an ARM except for one of our what we call non-QM products, which are much, much higher rates. They're non-traditional mortgages. We haven't written ARMs other than that. I mean, just to give you guys all an idea where interest rates are, if you were to put 5% down on a $400,000 property today, that was a primary residence in, let's say, you know, a place in Plymouth County, you know, or Middlesex County or Suffolk County or Norfolk County. You know, basically in all those counties, a $400,000 loan with 5% down, your credit score was over 700. Your interest rate today would be 2.375. So like taking out an ARM on any loan that's less than like 690,000 just wouldn't be advisable, because the 30-year fixed rates are so much better. I mean, for you all to be aligned as home buyers, whether it be a first-time home buyer or looking at seeking an investment property or anything, these are the lowest rates ever, right? And we've said that multiple times over the last few years. In 17 years in doing this, and you know, looking at historical data, lowest rates ever. It's a super, super great time to buy. I think the one thing that we have to say on the mortgage side is you definitely have to have a plan. We last week was the end of the month. You had to close by Friday, which was a big closing day. We had multiple purchases of ours put on hold because the sellers couldn't get their financing act together quick enough to move. So my buyers got delayed because sellers, mortgage companies for their new home couldn't close on time. So again, it's like, it's all about setting expectations up front and having a clear path and clear plan, because if you don't, it's not going to work. Like, I had an agent call me today. It's like, we want to close in 28 days. I'm like, you can't. I mean, with low rates come extreme volume. So there's a lot of people, I wouldn't say, buying is at its peak. This is a great time to buy. I'd say refinancing is probably at its peak right now. So there's only so many appraisers, attorneys, and lenders out there for the amount of people looking to do it. Again, every single person, like, people who redid their mortgage 6 months ago, we're doing it again. Like, because rates are almost a full point lower than where they were, in pre-COVID. So the answer to your second question, so PMI, okay? So whether you're putting 3, 5, so when you're looking at down payments, everybody, 3% is mass housing, okay? Mass housing also has a 100% option as well, but it's really tough to get an offer accepted with that amount of money unless the house has been sitting for them to do a 100% financing deal. So 3% mass housing, 3.5% FHA, okay? FHA compared to mass housing and other 3% down programs like Fannie Mae and Freddie Mac have Home Possible and Home Ready. They'll do 3, 5, 10%, 15%. Those are kind of your markers you want to look at. It makes no sense whatsoever to put 4% down. It makes no sense to put 6.5% down. I would tell you to do 5% and keep the money in your bank. Okay. So, and the reason being is you get no difference in interest rate or a PMI calculation percentage. Okay. So private mortgage insurance, or PMI, is different. It's the same thing that's going to be offered by any lender out there. And it's really based on your loan to value, meaning how much money you're putting down, and your credit score. The third thing would be your debt to income ratio. So those are really your 3 factors with that. And it's just a percentage. Now, you can either do what's called a single premium, and you can bake it into the rate. So you could say a single premium, let's say with 5% down on a $300,000 home, like a 700 FICO credit score, would be, let's say it's $3,000. If I give you an interest rate of 2.375 today, it wouldn't have a lender credit of $3,000. But if I bumped your rate up to like 2.75, I bet you we'd have a closing cost credit of $3,000 where I could pay your PMI single premium fee. So therefore, you are paying PMI as a lump sum in your rate, but your rate is tax deductible. Your interest for your rate, plus it's 2.75. Lowest I'd seen prior to this year was 3.25 on a 30-year. So 2.75 was the lowest I'd seen on a 15-year. So, doing a 2.75% no PMI loan, that's like the gift that keeps on giving, right? Or what we look at with PMI is what's the fastest path to get to 20% loan to value, 80% loan to value. So with PMI does not go away for an FHA loan, okay? I'm gonna tell you right now, I make a lot more money on an FHA loan, and so does my branch, and so does everybody else in the country. FHA loans are great for mortgage companies. What they're not great for are home buyers, okay? If we have to do it, we do it. It would be a credit reason or a debt to income ratio reason to do an FHA loan. They're stricter with home inspections and or appraisals. So, there can't be peeling paint. There's a bunch of other safety rules with them. And to be quite frank, Mark can answer this question too. A lot of lenders, specifically condos, no one's going to touch it, and no seller is going to let you finance with FHA unless it's a last resort and the place hasn't sold. So FHA is something you kind of want to put on the back burner. You'd only go there for a reason, and you got to make sure that whoever you work with doesn't just push you there, okay? Because a lot of people do. Like, we do a lot of volume, so we don't need home runs every month of FHA loans. We only give them to clients that absolutely don't qualify for the other products, okay? So PMI can be a fixed monthly expense though too, and depending on your income category and depending on, you know, what the next president and or administration brings in, there are certain people that qualify from either a single person or, you know, two people filing together married for a deduction of PMI, but it fades out over time and it could go away anytime. PMI has actually come down quite a bit, folks. It's the percentages are super low. And again, we always look at what's the path, right? So we show you the single premium and we show you what the monthly premium would be. Because some people, they're like, hey, I'm getting this house. I'm not ever moving. Like, you know, Mark and I and a lot of other realtors have seen a lot of people buy their first home in the city, they buy a condo, and then what do? That's their investment property for the rest of their life. They're getting a rate of 2.375 today. I can tell you right now, they don't care about the PMI factor. They want the longest, lowest rate because they plan on this house being the catalyst to the next house, right? So hopefully that explains it. We could break, you know, it's really ask your lender to break the stuff down for you because it's super simple. I've got someone looking here. If looking at multiple properties, can there be approvals for different price points for each property? Yes. Yep. Pre-approvals are, you know, we don't rerun your credit every single time. Basically, pre-approvals are given as many times over 120 days as needed at all different price points that we can offer. So, and they're super easy for us to issue. I can issue them from just about anywhere because we can do them from our cell. So another one would be another question for easy math purposes. If a buyer has 100K in cash and is interested in the house in the 500K range, but knows they can get up to an exemption gift of 30K from their family if they need to compete bidding, should they get a pre-approval for a higher number? So what I would say is, again, Michael, that what we would look to do is, you know, with the property that you're looking at, we can, like, we've pre-approved people and shown 20% down. And in the end, someone came and said to me, hey, listen, you did qualify me for 10% down too, right? And I'm like, yeah, we did. And well, I want to change it over to 10% down because I want to put that other 50K. My wife or my spouse or my partner wants to redo the 2 bathrooms right away. Completely understandable. We can do it. You just have to realize that once you enter into a contract, right, that you're bound to buy that home, okay, with a certain amount of money down. And if you, like, we can't furnish you a denial for something less. So you can represent whatever you want. You just got to make sure that you can deliver on the loan at the end. The seller doesn't care. They just want to get paid at closing and walk away. So, but yeah, we can, you know, kind of, again, there's a strategy that we'll look into for every deal, you know, for making an offer, you know, with your real estate agent. So, and that strategy is really important.
Pete, I want to jump in with a question regarding deposits and things and mortgage contingencies. So if we put together a deal for someone, they're buying a house, we have it accepted and it has a contingency for the mortgage, and that date comes up, and let's say they get denied on their mortgage. They can't get the mortgage for whatever reason. They lost their job. They were close all along and they just couldn't get it. What happens? And logistically what happens, and then what happens with their deposit that they put down up to this point on the home that they thought they were going to buy?
So, you know, in regards to your mortgage contingency, I mean, it's a really important date. And again, this is part of the strategy, folks. If you're making offers out there and your agent and you aren't talking with your lender, and like I just said before, like someone called us there, was like, oh, we're closing in 28 days. And I was just like, appraisals are running 2.5 to 3 weeks in all areas of the country right now. So we'd have to get, a rush appraisal, which is going to cost you more money than we've already quoted you, because now you want a rush. So, really depending on how your contract's written, we go through what that date is up front. Now, if you can't meet the date, right? So the mortgage commitment date is between you and me and your and your this is a date for you as a home buyer. The seller in that situation, right? They have no right to see your see your mortgage commitment. The only right that they have is to say yes or no if you request an extension, or the right to challenge if you give them a decline letter. So, basically, why would you seek a mortgage extension? Like I just said, your appraisal was delayed, okay? You go in, you make an offer today, right? Say there's not a home inspector ready for a week and a half, and you've got a mortgage commitment due in 3 weeks. So a week and a half goes by, we start the whole loan process, but we're going to advise you like, hey, I can't really order an appraisal and have an appraiser out there until your inspection's done. You don't want to spend the money on that, right? So now it's, let's say, a week of the home inspection, we're good to go. Most appraisers are requiring a purchase and sale to go out and do an appraisal these days because they don't want to waste their time. So they want to get in and get out because they have more orders than they can handle. So you're not going to sign a purchase and sale unless you've got your home inspection done and everything's worked out, because that's your final contract. So again, we would communicate with you and your agent and make sure, and the attorney, to make sure there's ample time in that mortgage contingency date. Because if you don't meet that date, right, and it just goes by and all of a sudden one of you loses your job, or there was an emergency and you had to drain out your accounts for like health reasons or whatever, who knows? You have to perform there or you lose your deposit. So the mortgage contingency is the last date where you could say, hey, listen, Pete, I can't buy this home. We had a health emergency. I don't have the money anymore. Okay, get issue denial. Hey, Pete, we lost our job. Okay, like verify that, and we'd have to do it. Now, I could tell you honestly, I haven't issued a mortgage denial in 8 years. So we have a pretty good way about delivering for our clients and our real estate partners. We like to, give you that certainty, not only up front, but, get you all the way to the closing. So, we haven't dealt with a lot of denials, put it that way. Now, a home doesn't appraise, you may have an out. It depends how your contract's written, right? If you're only putting 5% down, your home doesn't appraise at, $350,000 purchase price, you may have an out because you don't have any more money to put down. So that would cause a renegotiation and an extension of that date. So, it's super important though that, again, you have people that are on top of this stuff, because if the dates aren't nailed down, you've got a lot of money. I mean, you're putting usually $1,000 down with the offer, right, Mark? That's pretty much the standard. Mm-hmm. And then you're putting 5% of your purchase price down the purchase and sale, which is standard. I mean, sometimes you're doing more or less depending on your situation, but those are really kind of the tidbits of what goes on with your commitment date. It's an important date. We're very serious about it. We've got alarms and calendar reminders that go berserk many days before. So we make sure we hit those dates for you.
Chris Cowie, are you still out there?
Yes, I am.
Can you in a short amount of time encapsulate what you just went through with one of your clients with regard to the appraisal and renegotiation? Because I think it's a good example.
Yeah, of course. So I recently, about a month and a half ago, went into contract with a client to buy a house. It was a bidding war, frankly, and it went up a little bit higher than we originally wanted, but there were offers there to justify kind of getting up to that that point. So we got through the inspection. About as Pete's been saying, appraisals are backlogged. So the appraisal came about 2.5 weeks after the inspection, and we got the appraisal back, and it was about $17,000 below where we wound up with the offer. Pete, you mentioned this earlier. It was he was a 5% down buyer. But he did not want to spend it because the house needed a little bit of love. And as he said, he originally went in with a higher, or he'd spoken with his mortgage lender saying, hey, I can afford 15% down, but I really want to do 5 because I've got some work I want to do to this. 2-family, he wants to get it rent ready. So it was a back and forth with, it was a tough conversation to have. It's certainly a conversation I didn't want to have with the seller's agent because I had to go back and say, hey, listen, we need to find a middle ground here because it didn't appraise for what the offer was. Ultimately, we did come to a very reasonable agreement on it, but that was a bit of a fire drill. 4 weeks into the process of buying the house, and in today's market, you're seeing a lot of people bidding up the properties. So this was just one example, but I'm sure there are many more out there where they don't appraise at the value that they wind up at. And it's a tough conversation, but you have to be ready to have it, and you have to be willing to negotiate and willing to have a tough conversation if it comes around. Hopefully it doesn't. But if you, your agent, and the lender are in cahoots and you've got a good grip on everything, luckily it wasn't drawn out. We had it figured out within a day.
Yeah, the sellers said, you know what, we'll reduce it by that amount because we want this to go forward.
Yep.
And it's not ideal, but we're going to do it, right? So
yeah, it was. I mean, we lucked out, to be honest. I mean, I prepped my buyer that he was probably going to have to come up $5-6 grand, preparing for the worst, and we wound up with the best option there. But it was definitely not a fun conversation to have, but it happens, and it's
that appraisal piece. People don't necessarily know about appraisals, but I used to be an appraiser. All an appraisal is really a professional opinion of value. So it's a person's opinion on a given day using the data that they pull up. Sometimes there's a lack of data. So
that was a big driving factor with this one. It was a pretty unique property for the region, for the location it was in. It was in a single family neighborhood. It was a multifamily property.
Yeah.
And it was in a price point that there really wasn't much. The appraiser had to stretch himself to find comps. And so I think that was one of the reasons that led to this, this undervalued appraisal, just because there wasn't that much out there for it. I'm still a firm believer that, it's worth what we put the offer in at. And there were 5 other offers to kind of justify that.
Yeah, but banks want to see.
Yeah.
They always want to see something that occurred earlier.
Yep. Exactly.
If they're financing a 500. They want to see a $500,000 purchase last week.
Exactly. Yeah.
They don't want to be the first ones to be buying on the street for 500 grand because banks are conservative by nature.
Yeah.
That's the tricky part.
And I think with the seller, Chris, hopefully understood that that's kind of what they were getting into with 5% down buyer. Somewhat, but there's the protections that you as real estate agents cover with your team and in your office, and the attorneys, etc.
From a legal standpoint, we were fully protected. We had the right to back out. We were good to go at that point, but he really wanted the property, and the sellers, because the market's so hot, the sellers still wound up getting above ask at the appraised value. So it's not like they didn't make out. They're still running away like bandits.
Yep. Yeah, appraisals are tough right now. It's something that we're dealing with a lot, and we've had a lot of people we haven't had a lot of issues. It's just you know, the first thing that comes to us is, well, let me see the appraisal. What are the comps? And then it's the, kind of the agents getting involved, trying to figure out where that price point should be. And like you said, some of them could be, as Mark said, some of them could be, setting the bar, which is not, something that, again, we as the lending institution, we look at an appraisal and we make sure the comps match up and, that they're within the correct location. And then we're running our own reports behind the scene, believe it or not. And, we spend an extra like 15, 20 bucks on every appraisal to run a report that basically is like a bullseye around where the property is to make sure that the appraiser didn't purposely leave out other properties. So, we have a lot of that information behind the scenes already. So, anyways, that's a great example, and it's really important that, your agent understands this information like you guys do, because it's a lot of people are just like to not be the solution and like to cause problems with that stuff. So it's good to have problem solvers on your team.
Yeah, totally. Aaron, did you have questions about taxes from last week? Like different tax ranges? I mean, the only thing I was just going to say to Pete is what I told these guys last week, Pete, is that the variables that change from one property to the next are taxes, condo fees, water, flood insurance, things like that. So when you look at pre-approving someone in a region, you basically want to get an estimation, right? Is that what taxes typically for your range, your price range are between X. So you plug in some estimations, right?
Yeah. So basically the way it kind of goes with, the process is, the client will come to us, will be referred from usually a real estate agent, one of our partners, and then we'll set up a call, like a 10 to 15 minute Zoom or in-person, sorry, not in person with COVID, but phone call, not on Zoom, but, and basically what we're going to do is just kind of, I just take like a mental download, ask you a lot of questions, kind of figure out, everything that's going on in your world. And then what we have you do is we send you a link to your via text, and then we ask you to download like an app on your phone that you use the whole mortgage process. So it's either you or you and your co-borrower, you download that app right on your phone. And then basically what's great about it is that now you're able to kind of access wherever you are. You could be at breakfast, you could be, in between meetings, you could be in an Uber, and you can be signing your mortgage documents, signing your application wherever, because everything's mobile these days. Then once that happens, we'll verify your information. And again, we've done this as quickly as 30 minutes, giving you people a pre-approval, had a strategy, and had them make offers. Like, we'd rather not do the last minute stuff, but it happens. And then we kind of go through, I make sure everything looks great. And then the next call with you is really kind of identify your area. So if you said like, hey, listen, I'm looking to buy a home in Quincy, right? And I'd say, okay, you're looking at condos, single family, multifamily. We're looking at condos. I said, okay. So now I know how much you want to put down and where you want to be. So that's the important thing about what we ask that I think a lot of people miss is if you tell me you want to spend only a certain amount of money per month, I automatically know in the top of my head that, okay, you want to spend $2,000 a month, total all in, including condo fee, and you've got 5% to put down. So I'm going to say, okay, probably going to be around $350,000, $400,000 condo today, right? And then what I'll do is I'll start going through online with you or ask you for an example of something that you might have seen, on your, home search. So in the meantime, we're already setting you up with your agent, so, we're sending them an email. We're saying, hey, I think we're going to be in this range. And then, Mark and his team, you guys are setting them up on MLS to go out and search for homes, right? So the key is, Mark, is that we'll identify tax rates by a town. So like if you're looking in the city of Boston, we know that in all the different sections of the city, no matter where you go, there's one thing that's great about Boston. You get a residential exemption, okay? Which means you get up to like $2,900 off your tax bill annually automatically if you live in the city as your primary residence. So if your normal tax bill is like $4,000, like I had someone the other day had a $500,000 purchase that a year later we were refining them. I'm like, holy smokes! I'm like, your taxes were like $85 a month because he had the residential exemption and it was only assessed at like 410. So taxes were $88 a month. He didn't have to escrow insurance because the insurance was part of the master insurance policy. And it was like, this is great. I mean, he's like, oh my gosh, I can't believe, because when you buy a home, I can't always transfer with the residential exemption because most of the time the assessment's going to catch up with you and you'll have a tax deficiency down the road. So really identifying the area and running examples, like I'd be like, okay, Aaron, let me take a look. Okay, so you're looking for a $400,000 home. Great, you're looking in this town. And I'll just be searching online myself and say, okay, I found 15 Cedar Street. Even though you're not looking at it, and then I'll look at what those taxes are and I'll make an estimate based off that, right? So the only difference would be is if a place was recently redone or newly constructed, where I just go off the purchase price times the tax rate, okay? But again, we'll give you all this information per property, which I think a big differentiator is whether you're working with us or someone else, you definitely got to demand the numbers. You can't go out and make an offer on a property, not know what it's going to cost, right? So, you could have been looking in Quincy, now you're looking in Canton, or you're looking in Norwood, or you're looking in a different area, and you got to make sure that those taxes are going to be right and that someone's actually looking at these numbers for you. So yeah, insurance wise though, Mark, we generally estimate, I mean, I have an estimator.
Mhm.
I know just because of the amount of deals we do that a $400,000 single family in Hanover, Massachusetts is probably going to run about $1,200 a year or less.
Yeah.
I know if you're going to look out, outside the 495 belt, or you're farther away from the ocean, you'd probably be looking at $1,000 or less for that purchase price, right?
And Aaron and Emma Toasty, the insurance piece comes in later. It's very simple to add the insurance piece. So we know the estimation, and then a couple of weeks before you're closing, you call your insurance agent and say, I'm buying a house, here's the address. Can you give me a quote? You might call a few others. And then what they basically do is ask you to either prepay or get it set up so that insurance is in place, so that at the closing table, the bank knows that your insurance is in place. Because the bank does not want to loan you money on a home that you're both buying without insurance in place, because that would be
Right.
bad.
But when we say like, oh, our budget with everything included is $2,000 a month, does that number include the projected insurance?
Yes, 100%.
Your PITI, principal, interest, taxes, and insurance. PITI.
Yeah. So we're going to look at that whole thing. And again, give it a rough estimate. I mean, I think the big thing is you got to determine, like, even some other, areas that you might not think. You just got to make sure, I know all the agents do on this call, that, there's no flood insurance. It's really important because that can change your policy. If the home is older, policies might range a little bit, Mark. So like if you're buying something that's like pre-1900, just beware that like you could have other insurance policies. But we tell people to kind of go with their others. The only insurance advice I have for you all is, like the go-to thing is like, the majors, like the Geico and the who else? USAA and some of these other big companies. I really advise that if you're buying a condo, we'll figure out who the master insurance is through. You should get a quote from them, because if there's a problem in your condo, master insurance will be involved anyways. So if you have to get that secondary insurance policy, it's called an HO6 policy. Basically covers the inside of your property. Some condos have it where it covers it all. Some condos don't. And then for a single family home, a lot of people will bulk it with where their car is, which is really smart. You just got to go out there, just like you look at mortgage rates, and look at different rates, because a lot of insurance companies, unlike your mortgage where you're set for a long time, insurance rates change annually. So that's how they make their money. They, you know, they'll lead you in, give you a great rate off the bat, but, you know, then a year later, you're like, oh, why is my payment going up $20 a month? It's because you just paid, you know, an extra $120 a year for your insurance.
Yep.
So those are really the only ways your payment can change. You know, is if your taxes go up and your insurance goes up. And the only way your taxes go up is if your assessment goes up. And your assessment will go up if you did work to the property, or if the area assessment of taxes went up, right?
Another way the taxes could go up, Aaron, is if you're looking at a house that, let's say, hasn't sold in 50 years, and the assessor for the town has not been there for a long, long time, and in the past few years they've really renovated it or whatever, and so let's say you buy it for $400,000, and the assessment currently when you buy it is like $220. The town thinks it's worth $220, and you pay $400. That's going to send a red flag. In about 6 months, the assessor is going to go, that house sold for $400,000. We have to up the assessment because clearly we weren't catching up with it, and so your assessment might go to $350 or something. So when you're working with an agent, you kind of want to keep an eye on that, because you should have that expectation that at some point in the next 12 months, the tax is going to bump, you know. So. Awesome, Pete. I don't know if anybody has any more questions, but that was really comprehensive. I really thank you very much for doing all that. I know it was a lot, especially at 7 o'clock. And everyone wants to know who the new president is going to be, which should be in the next 2 hours. And I'm already drinking, so.
Thank you so much, Pete. That I just learned so much. We have a lot of notes, and I appreciate it so very much. And
Yeah.
everyone else on this call too.
Yeah, seriously, these workshops have been so helpful, and that was so much great information that answered pretty much every question that we had. So thank you so much.
Sounds good. Mark, I'm not sure if you're going to know in the next 2 hours, but we'll
You're probably right, but it's getting closer.
we'll see. It's getting closer.
It's we're at, I don't know what we're at. We're like, I don't know. I won't get into the
Don't do
politics
it,
right
Mark.
now.
Yeah,
We're getting closer.
don't do it.
Not
right.
the best idea. All right. Thanks, everyone.
Thank
right.
you.
Bye, guys.
Thank you, everybody.
You guys.